Imagine waking up, checking your phone, and seeing cash deposited into your brokerage account from major companies like Apple or Coca-Cola. No trading stocks, no selling shares, and no clocking into a job. This is the reality of dividend investing. However, picking individual dividend stocks can be risky. Just one bad earnings report can erase your payout. That's why smart investors turn to dividend ETFs. In this video, we will explore how to create a hands-off, cash-flowing portfolio using the best dividend ETFs available. First, let's clarify what a dividend ETF is. An exchange-traded fund, or ETF, is essentially a collection of stocks you can buy with a single click. A dividend ETF focuses on companies that consistently pay dividends. Instead of managing numerous stocks, the fund manager takes care of everything. They collect dividends and send them to you, typically about every 3 months. This means instant diversification and reliable cash flow. Now, not all dividend ETFs are created equal. Some can build wealth while others can be dangerous, yield traps, that harm your capital. When evaluating a fund, use a 4-part checklist. First, check the dividend yield. This shows your annual return from payouts. Avoid yields over 8 to 10%. It often signals trouble underneath. Next, look at the dividend growth rate. Seek funds with a 5-year growth rate of at least 5 to 7% to beat inflation. Third, consider the expense ratio, which is the management fee. Aim for an expense ratio below 0.10% to help your compounding grow. Finally, assess the quality of holdings. Ensure that top holdings are stable companies, not those struggling with debt. When selecting an ETF, you'll typically choose between 2 strategies: high current yield or dividend growth. High current yield funds aim to maximize cash flow today, generally yielding 4 to 6%, with steady price increases. They work well for retirees needing immediate income. A prime example is the Vanguard High Dividend Yield ETF, ticker VYM. On the other hand, dividend growth funds focus on growing future payouts. They usually yield 1.5 to 3%, but with high capital growth over time. This strategy suits younger investors. A popular choice is the Schwab US Dividend Equity ETF, ticker SCHD. Ready to start? Here's your 3-step action plan. First, automate your contributions by setting up your brokerage account to buy a set amount of your chosen ETF regularly. Second, enable DRIP, the Dividend Reinvestment Plan. This allows your dividends to automatically purchase more ETF shares, compounding your wealth without additional fees. Lastly, leave it alone. Stop checking daily stock prices. The strategy thrives on time. Dividend ETFs aren't about quick riches, they're about reliable wealth building. Shift your thinking from a consumer to an owner, and you can create a personal income stream. If you found value in this video, hit subscribe, like, and share it with someone pursuing financial freedom. What's your current favorite dividend ETF, or are you still deciding? Share your thoughts in the comments.